So let's take a look at our homemade tool just to see what the impact is. If we look at a 35-year-old couple that's going to retire in 30 years at age 65, we can calculate their spending goal by looking at the today dollar it would take to retire, and let's say they want $5,000 per month. If we have a 0% inflation, then the goal stays at $5,000. But historically, inflation has been somewhere between 2 and 3% over the long term. So if we take that $5,000 and inflate it at 2%, we come up with $9,106 per month needed. And if we were to go with 3%, that number jumps to $12,284 per month. So let's go in the middle. 2.5% inflation for 30 years. We're going to need $10,577. So that may seem a little bit scary, but of course we can factor in things like Social Security to help offset how much money we'll need in the future. Let's just assume that both of our Social Securities are $2,500 per month, and those are inflating at 2%. The bottom line is, with Social Security, we're able to cover some of our future income, but a big red percentage is still going to need to come from assets. So the last part of this spending goal that I wanted to chat about was just the impact of tax. If we think about spending $5,000 per month, that's a net number, but we need to gross it up so we can account for the taxes that we'll potentially need to pay. If we were to assume a 15% tax rate in retirement, in order to spend that $5,000 per month net, we would need to gross $5,882 per month. That's 18% more money. Now, 15% tax rate is one thing, but what if we were wrong? What if our total tax rate between federal and state was 20%? Well, that $5,000 per month we want to spend would now require $6,250 before taxes, which is a 25% increase. Who's to say that your taxes will be 15 or 20%? Depends on a lot of factors, but I hope this shows you that it's really important to know what that expected tax rate is and to make sure you're right. Because ultimately, if you're off and your taxes are much higher than expected, that number of how much additional you'll need could compound and compound and compound. Over the course of 30 years, you may find out that you need several $100,000 more than expected due to the impact of taxes and maybe other costs, such as Medicare surcharges, etc. Overall, taxes are a big expense in retirement, so make sure you plan for this so that can be one less thing to worry about in your happy retirement.